And welcome to ETF Edge, your go-to place for everything ETFs. I'm your host, Bob Pisani, and we want to focus today on two very specific topics. First, the S&P 500 snub of Tesla, that's what it was, and a new exchange that focuses on ESG-type investors. Let's start with the S&P declining to include Tesla in its recent announcement of new inclusions. We're talking to Tom here, Tom Lydon, and of course, some other people we talking to on a regular basis, Andrew McCormick as well. Tom, we often say the S&P strives to contain the largest companies in the United States. How is it that they excluded Tesla at $360 billion? And I think that's the 10th largest company in the United States. What exactly were they thinking in excluding this?
Yeah, you're right, Bob. I mean, the key point here is the S&P 500 is not the 500 biggest companies. It's actually an actively managed index. And they made the decision, even though it met some of their criteria, not to include it. So what's interesting here, Bob, is when you look back 100 years ago, the Dow Jones Industrials was the benchmark. 63 years ago, when you and I were babies, it was the S&P 500. I think the S&P right now is playing defense. And many investors and advisors and institutions are looking for indexes like the NASDAQ 100 that are a little bit more modern in nature, that will take into account, especially in this new economy, companies that are more forward-thinking. But they didn't want to take the gamble on Tesla, and that would have been a big move for them, and they're under some scrutiny for that.
Yeah, I could take the other side.
You know, Andrew. Go ahead, Andrew. But
go ahead.
Go ahead, Andrew.
I think that it's okay. I mean, you're exactly right. I think investors will go to other indices. However, I'm not always the biggest believer in that history always repeats itself. And we're in a new time with the meteoric rise of some of these companies. I'll point out that Facebook took over 6 months to get included, and I would argue that Facebook had more of a people thinking about what it meant for our, for everyday life than a Tesla, even though Tesla's actually obviously done quite well. But to have a little bit of human intervention, I'm actually in the camp that that's still okay. Does that mean that slows them down? Does it mean that people say, they're not up to the times? As it pertains to investing, I've seen a lot of rules-based only investment strategies not do too well in this kind of environment. So to take a pause and say, we're going to look at this and just think it over, it doesn't mean that Tesla's never going to make it. I think they're just taking a pause.
Yeah,
I think they probably will get in.
We also have companies like Zoom, DocuSign, Moderna, which are getting a lot of attention these days. They're getting a lot of growth. They'll probably continue to grow over time. They're not in the S&P 500 either. They are in the NASDAQ 100. So again, we just have to be more sensitive to it. Yeah.
The question is this: do investors want more certainty with a rules-based system like the Russell 1000? I mean, this will go into Russell 1000, obviously, but this is a reminder, I think, to everyone. The S&P is not rules-based. It's essentially a committee. There are some general rules, but they have a lot of discretion. And obviously, here, they didn't consider size as a critical factor for inclusion right now. Do you think investors are more comfortable, Tom or Andrew, with rules-based systems now that are more easy to discern what exactly the rules are?
Right.
Well,
but it's very easy to say go ahead, Tom.
No, go ahead.
It's very easy to say a rules-based system is working now, and now it's not working now under the current rules, right, which is going to have its popular times and not. I just am a little old school in the thinking that S&P has a brand and a trust, if you will, right? And you'll see that in that why the institutions and endowments and let's say pension plans, that have promises to their long-term employees, their benchmark ends up being S&P because they kind of trust the process. It's not to say that rules don't work, and there are rules with the S&P. I just think there's some old school thinking in that and a brand that they've kind of built with that name, doing kind of a hybrid rules. But we have the right to change, not just value those rules in.
Yeah, I think the important point here is that we often say the S&P 500 is the 500 biggest companies, and it's not. And while they strive to represent the large cap part of the stock market, it's not quite accurate to say that they're the biggest 500 companies that are out there. And this is a good reminder of that. I think a better question, guys, is why did they decide not to include it? And I think probably, perhaps, the volatility was an issue there. I think also, what are they exactly? So if you put a $300 billion company in, that changes the market dynamics. What else are you going to necessarily leave out? Do they need another category?
Right.
Is it an auto stock? Is it a tech stock? How about some kind of new category maybe to be created in the future? Alternative transportation. I don't know, Andrew or Tom. Maybe that's what they need. Obviously, they're looking for some reason to include it, but they didn't make it right now. Why didn't it?
Yeah, my guess is volatility. You made up a great point, Bob. Now, all that makes a lot of sense. Let's look at a different stock just for an example. Let's say Moderna comes out and has the vaccine, right? That will be a really big company really fast if it's not already. And then 3 months later, God forbid, all right, this one didn't work, scrap it, AstraZeneca. And then what is the S&P at? Like, oh, sorry, we put that in there. We got to yank it out now. I mean, yeah, rules-based would do that for sure. But maybe that's a guess. Just a guess is that they think about the volatility and the rather meteoric rise of these names. But Tom, I'd love to hear what you think.
Yeah. So we know the S&P 500, 28% is represented by FANG and Microsoft. I think investors have enjoyed the run-up that we've seen in those stocks and what that's meant to the S&P 500 index. Going forward, investors, especially index investors, hope that they'll also have a piece of those future FANG stocks. When we see instances like Tesla, which is such a big company, not included, that concerns me.
Yeah. We're not going to settle this here. I think the answer is they're going to include it eventually, and I'll bet you they'll create some kind of new sub-index category. I mean, literally alternative transportation or something like that, and figure out a way to get it in there. I want to move on here because another fascinating second topic that we've got here today, which is there's new stock exchanges coming, folks. Three of them in the month of September. That's a fairly rare event. The question is, do we really need them? But the one we're talking about today is a very different one here. 3 new exchanges, as I mentioned, but the long-term stock exchange started trading yesterday, and they're pledged to support companies who share a long-term interest in sustainability, inclusion, and diversity, and treating employees fairly. Sound familiar? Those are ESG concepts. The CEO, Eric Ries, is joining us to discuss this exploding interest. You know, Eric, we do... Welcome to ETF Edge. We talk about ESG all the time. When I read about the long-term stock exchange a couple months ago, I said, darn, this is an ESG exchange. Is that a fair characterization of what you're looking for? What are you trying to do with the long-term stock exchange?
Well, there's no question that ESG is the hottest category in the markets. I mean, what is it, $20 billion have flowed into ESG funds this year? And yes, we think that ESG, we think of it as kind of as a subset of focusing long term. So when you're focusing on outcomes like resiliency and having a stakeholder approach, that's really increasingly what shareholders in society demand. And what we want to do is focus companies on that long-term horizon so that things like sustainability, good governance, treating employees fairly, operating in a 21st century way in the communities where companies operate, that becomes a natural side effect or consequence of that philosophy of long-term thinking.
And what amazes me is you really sort of walk the walk. I was looking at your board the other day, 80% women on it, all eminently qualified, the top people in the field. I guess the question is this the right time to do it? This seems like a hard sell. I mean, everyone buys into, we see the oceans of money going to ESG. People are buying into the concept, but can you build an exchange around it? Now, initially, we had a conversation a couple days ago. You explained to me you're going to go after private companies that are seeking to go public initially to list on the exchange, but you're also, in the future, interested in current companies that are listing on the NYSE or the NASDAQ, for example. Do you believe you could successfully get, I don't pick a company, a Procter & Gamble, I'm just picking one out, to change based on the idea that you have a higher listing standard? Would companies be receptive to that argument? Has ESG advanced that far that you think you could succeed in doing that?
This will be the acid test of all these pledges and commitments. I think it's one thing to sign a letter. It's one thing to put lofty rhetoric in a press release or a financial statement. But the question is, what have companies really committed to? So if you look at it from the investor's point of view, a lot of ESG investing is about finding the least bad company in each category and investing in that. Nothing wrong with that. But how are we going to get net new ESG qualifying companies? How do we influence the mind share of the next generation of managers so that they view this as a source of competitive advantage? Now, part of that is on investors to support the companies that are taking these bold stands to make sure, the evidence is very clear that having long-term investors on your cap table is a source of strategic advantage and leads to outperformance of any company stock. So if investors and managers are partnered together to produce these outcomes, I think that is the path forward for our society. And listen, that's what stock exchanges at least used to be all about, bringing investors and companies together for mutual benefit.
Bob, I have a great
I don't
point
think
to
anyone
back
would
that up.
disagree.
Yeah, Eric,
Go ahead, Andrew.
Right, if I can jump in for a second. So there are fewer and fewer companies that are moving from private to public these days. We know that, and when they do go public, there's a lot of pressure on. And there are a lot of business decisions to be made. Can you make a case for having this thematic platform, but also offering similar or even better economics, technology, listing benefits that a company in going public that would be ESG oriented would want to choose your exchange?
I really appreciate that question because I don't get to talk about this very often. I'm a technologist by background. That's my training. And LTSE is first and foremost a software company. So this is not just a legal innovation, a technical, legal listing standards innovation, although those elements are very important. It is also a software platform. And we do think that there are opportunities for technology to improve the engagement and relationship between companies and their long-term investors. We're a big believer that companies need to have transparency into who their long-term investors are. And we think that long-term investors ought to get privileged capital raising opportunities from companies whenever possible. So, I don't know that in the early days of this, we'll ever get to a point where long-term investors, buy stock at a lower price than speculators. I think that, that's a dream one day that we could start to differentiate between the tourists who are just passing through and the citizens of the republic who intend to stay. But I think there are a lot of ways to create true mutual win-win beneficial partnerships between genuinely long-term investors and the managers that want to engage with them.
Yeah, I
how
can
do you feel about the? Go ahead, Andrew. You want to make a point?
I can make you feel good about that point. I was going to say, because I'm going to tell you, under the hood of the ETF industry, since we're looking at, that, your point is true. I mean, a lot of the push is like, wow, Robinhood, everyone younger wants to be involved in this. But I can tell you, I was on the phone with one of the largest ETF strategists this morning, Horizon Investments. They make it part of their core strategies, right? And they view it as a factor. And a factor to them is a subset of securities that investors value higher. And they're already at Gen 2, so they're not simply putting the ideas into their portfolios. They're already doing risk mitigation into that. So what that tells you is if you're doing risk mitigation, that means you're holding on to this investment for a long time. When you get these big strategists who can raise a lot of money and stay long-term and have a great reputation like Horizon does, then you're going to have sustainability, and that is already happening. Not that the Robinhood investors don't drive money. They certainly do. But I will tell you that it's already happening with the strategist community in ETFs.
100%.
How do you feel?
And the other thing I think is interesting is
Eric,
this next generation of companies, they don't, a lot of them, they've been very focused on growth, on technology, on building a brand. They have not necessarily started to engage with these issues in the broad way that investors might assume, given their size and sophistication. So there's a genuine opportunity here to win over hearts and minds and to change the governing philosophy of the next generation of companies, and that's the ballgame.
What's interesting to me about ESG is, well, in theory, most people would subscribe to the idea behind it, and there is finally money that's definitely coming in. We saw these numbers that we just put up earlier. Yet we're seeing some pushback against this. The Labor Department, for example, just issued some commentary, essentially trying to remind fiduciaries that they should not be pushing what they call social agendas, that their job is to maximize profits for their investors. And including people who are voting as proxies on that. I know you pay attention to this, Eric. Do you view this as a sort of temporary pushback on certain parts of the of businesses like oil that are not necessarily being very well treated by ESG, and something to overcome? Or do you think this is a serious objection that some people like the Department of Labor have had?
I mean, it's basically ridiculous. I mean, in the middle of a pandemic and all of the other crises that we're living through that have made it crystal clear that human capital investment is not a luxury but a necessity, the vulnerability of supply chains, the fragility of business models. Like, if there ever was a reminder that conditions change and that what is material for a company one day suddenly is not, or vice versa, we've really seen this in this crisis in particular, that companies that act to keep employees, suppliers, and workplaces safe, they are the ones who are performing in ways that those stakeholders are going to remember for years to come. So to say that that's a social agenda or that's not material to business performance, I mean, I don't know who said that, but that is pretty absurd.
I mean, the employees want to stay at those companies. They don't want to leave, and that's what grows companies, is happy employees.
I have spent 10 years trying to reform companies in a variety of ways, through my work on the Lean Startup. And if you've never sat in an all-hands town hall meeting of a large company and watched the questions that employees ask to CEOs and seen that change even over the last 10 years, the pressure is not just from Wall Street anymore. Most companies that understand 21st century thinking, that are going through digital transformation, are in a war for talent. And the next generation of employees, let alone the next generation of investors, they're not going to tolerate this. So I think there might be some rearguard action, some pushback here and there, but this is a generational seismic change, and the next generation wants something different. And believe me, they are going to get it.
Yeah, I would agree. The trend is definitely in favor of ESG. How about the competition? So I'm trying to think about this. I'm the New York Stock Exchange, or I'm NASDAQ, for example. And I'm saying, okay, so there's this new exchange, a competitor, long-term stock exchange. And what they want is sort of higher listing standards, more ESG focus. And I guess if I was the NYSE or NASDAQ, I would think, well, that's nice, but there's nothing in the listing requirements of the NASDAQ or the NYSE that would prevent any company from having higher listing standards. I think that maybe their attitude might be, well, okay, but they can do that here with the NYSE and NASDAQ. Why do you need a separate exchange with a completely different listing standards? We'd welcome higher standards if the companies want.
Can you imagine
them.
if
Eric,
people
what do you say to that?
Yeah, we imagine people said that kind of thing about financial compliance. Like, we don't need standards and rules. So just, anyone can be compliant if they want to be. That should be good enough for the public. I mean, come on. When something's important, we standardize it, and we want to know that there's accountability to following those rules. So, beware companies bearing gifts. When you read an S1, when you read a prospectus, and companies are claiming to be a next generation company, believe in transparency and diversity and inclusion and equality, justice, fair, all these buzzwords are loaded up in these documents. I think the public needs to know who's for real and who's not. Now, to be clear, we don't view the legacy incumbents as competitors. And, old school, old-fashioned companies need a place to list too. So Philip Morris got to be listed somewhere, I understand. That's not really for us. We encourage companies to dual list out of an abundance of caution, still access the liquidity of NYSE NASDAQ if they want to. We're happy to be the secondary exchange. We don't need that extra subsidy of running the open and close auction every day. We want to hold companies to a higher standard and help them develop a governance framework that actually will allow our civilization and our capitalist system to survive and thrive into the next century.
Okay,
well,
Tom.
Eric, this is Tom. Just in final points here. I mean, there couldn't be a better time to bring this forward. We talk about ESG regularly, Bob, and it's not a fad. It's not going away. We can just see by the numbers. And then really, Eric, what you bring out, and today what everybody's going through individually with working from home, in their environmental and physical resources, social issues that are going on, it's a great opportunity to bring it forward. So best of luck.
Oh, thank you for saying that.
And really timely with the Citigroup hire today as well. We're very pro gender equality at Wallach Beth. We were very pleased with that news out of Citigroup.
Seismic change. The tides are the tides are changing. I'm blanking on my metaphors here.
Well, Tom and Andrew, you summarized my feelings exactly, so no need to have me do it anymore. We're out of time, folks. Very interesting discussion. This is a good example. We've been covering ESG for a long time here at CNBC on ETF Edge, and now we have exchanges that are interested in this as an ideological concept, as an intellectual concept for the good of the country. It's a side that things really are changing. And Eric, stay in touch. Let us know how you're doing. We're happy to have you back in the future. Talk about this as well. That's it for this week's ETF Edge. My thanks to Eric and to Tom and Andrew for joining us. Remember, you can watch all of our videos, etfedge.cnbc.com. And don't forget our podcast where we go into a little more in-depth on subjects today like the S&P 500 and Tesla. That's it, everybody. Thank you for watching and have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds. Expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.